create a joint, I think this is going to be a huge thing. Not only, I mean, I thought about this long before being at Land Advisors and looking at different scenarios, as well as what you guys do, is when you have a seller that is reluctant to sell because the bid ask is, the spread is too wide, or if he just thinks there's too much upside down the road that he doesn't want to let go of. And as it stands now, that's a dead deal for you guys, right? And if he doesn't want to sell, it's over. And I think one of the things that we'd like to explore further, where I think there's opportunity for everyone here, is what about if we structure a joint venture agreement together? And then the landowner can have a little bit of the best of both worlds, where he can lock in some kind of price now, but also retain some sort of upside later. And I think what is exciting about that is it's not only allowing you to retain an opportunity to earn some money, but there's a clean slate. There's no rhyme or reason as to how that deal can be structured. So my thoughts with today is we could go over just the basic scenario of joint venture equity and how the deals are that we do on the capital side. And then that will give you, I think the more education you have on those types of structures, the more you're able to then propose different scenarios to a landowner and really understanding what his objectives are. And that's where the clean slate is, and it takes the knowledge to be creative and putting something together. So, and anyone interrupt at any time, but if I go to a general joint venture equity structure, and I want to first preface, if you recall, we have debt, and I know this is, I'm going to the lowest common denominator here, so I know for a lot of guys it may be just, this is 2-101, but we have debt, which is the first the first position in the capital stack, and they have priority over everybody. Then in the middle component, we'll put mezzanine and preferred equity. Don't get confused between the nuances of those two. They are very similar. And I may use the term preferred equity a little bit more than mezz. Essentially, mezz would just be a higher rate coupon, very similar to debt that goes higher up in the capital stack, may even be a second note, so hence more risky and being priced in the double-digit kind of a range as opposed to a single-digit range for more traditional debt. Preferred equity, very similar to mezz in that it's behind a senior debt obligation, but rather than just having a fixed coupon that is paid out to the lender, he also has some profit participation. So it's really your combination of debt and equity where all the priority of payment is going to that preferred equity holder, but rather than being capped at a coupon, he also has some participation in the upside. Now, it's important to understand, and this is where it gets really creative as we go into JV equity, if that preferred equity holder has priority, it makes sense that he is going to get less of the upside because he is in a safer position compared to the common equity holder. So he may get a coupon with a 10, 20, 30% of the profits, as opposed when we shift to JV equity, it could be 50, 60, 70% of the profits because he's taking a greater risk. So that's preferred equity. Then we'll jump to JV equity, where if you recall the term for JV equity that is very common that we joked about will make you at least look smart or sound smart would be pari passu.
Right.
PARI-PASSU. I think I was given a hard time because I didn't know the exact spelling, but it's it's PASSU.
Hyphen.
Pari passu, yeah, the hyphen in between. And that essentially means your money is green as my money. Everyone is on equal footing. And that is the kind of the common foundation of a joint venture equity agreement, where there's no priority. If $1 comes in the door, it's split evenly based on your capital contributions going in. Now, that said, let's look at a typical JV equity structure that we put together between a operator developer and a capital investor. Generally speaking, the capital investor is looking for the operator to have skin in the game, as you guys know. And the typical amount of capital would be 10% of the equity. So if it's a $10 million equity requirement. They would expect the developer to put in $1 million. The investor would put in $9 million. And that would be a 90-10 is kind of the nomenclature there. So 10% co-invest. I know I'm throwing terminology at you, but it's important to understand kind of the different words that are used. So 10% co-invest translates to a 90-10 structure. And then that will be, for every dollar that comes in the door, 90 cents will go to the 90% guy, 10 cents will go to the 10% developer. Until such point you hit a preferred return. And that preferred return can be, generally speaking, you'll hear family or guys that raise money from friends and family will say, I got a 6% preferred. We run this problem all the time. They'll say, I get a 6% preferred return and then a 50-50 split thereafter. And that is the ultimate country club deal. And we face that problem when guys say, oh, I'm used to a 6% pref and a 50-50. And we have to re-educate them that if you have that deal, take it, because that's not the deal we're going to get you. A more of an institutional deal would be anywhere from an 8 to 10 and sometimes even a 12% pref. So, and that preferred return is accumulating. So if you have $9 million of a capital account, as it's called, every month a percentage of that 10% preferred return, if it's not being paid, is accruing and building on the capital account. And I know it's getting a little bit technical, but that kind of dives into the essence of a preferred return. So that 10% is accruing and compounding as long as that, and for your development deals, that's always going to be the case because there's not cash flow that's coming and paying down that 10% pref. So then once you have an event, meaning a sale or a refinance in the case of a commercial property, all that money is going to pay down the capital accounts. And you first go to pay down the preferred return that's been accruing on that capital account.
Actually, first pay down the debt.
Well, yeah, okay, sure. Thank you. That's Tom Farrell. Pay down the debt. And then once you're getting the equity, you're paying down the preferred return that has been accruing. Once you pay down the accrued preferred return, then you start chipping away at paying back the $10 million, 9 for the one guy, 1 for the other. Then once all your money has been returned, return of capital and return on capital, another kind of nomenclature thing, then you get into what's called a promote. And that is essentially the investor rewarding the developer of saying, thank you, you got my money back, you got my 10% preferred return back. Now I'm in a position where I can give you a larger percentage of the profits based on the money you put in. So a typical promote would be a 20% promote, which then goes to a 70-30 split. And you see that math. If the developer put in 10% and then he's getting 30% of the profits, that gap between your co-investment amount and what you're earning profit-wise is called your promote. And a 20% promote is relatively common in the institutional world. And then that's when you guys may have also heard the term waterfall structure. So then you may have a 70-30 to some sort of other hurdle of the waterfall structure. Let's say it's a 16. So then we're going to go 70-30 to a 16. And then once again, the investor says, thank you, Mr. Developer. You've done what you said you're going to do. I'm going to reward you. You've got me my 16% return now. Now let's jump to a 60-40 split, which would be a 30% promote above and beyond the 10% you put in. And that may go to another hurdle waterfall of, let's say, a 20 or 22. And then once you get a 20 or 22 or some number like that, then we can split 50-50. So that is the kind of typical structure. As you can imagine, there are all different ways to kind of zig and zag from that, whether it's a 5% co-invest. A lot of developers may want that lower co-invest. The institutional guys are going to push back and generally want more money in from the operator. So we do see situations where it could be as high as a 20% co-invest, and then that would just adjust the splits accordingly. Because if you did 20% promote off of a 20% co-invest, you would then have a 60-40 split after your preferred return. Everyone follow me there? So that's the foundation by which the typical deal is structured. Now, as it relates to you guys, where I think the opportunity is let's say the seller, let's say you got, does anybody have a deal example of a guy who is on the fence and doesn't want to sell? Do we have something, or should we just make stuff up? Okay, Tom Farrell, raise his hand.
Every single deal.
Party.
I got a call from a guy yesterday, and he's a pseudo broker, but the property's up in Valencia, and apparently, and I'm reaching out to anyone on the phone or in here, we Land Advisors did a BOV early last year, and I think it's about 260 lots. It's near Newhall Ranch, and it's owned by a family, free and clear. They're going through entitlement, and the guy needs, call it $3.5 million to get it to entitlement. So apparently LAO did a BOV early last year at $6 million. Well, he got an appraisal for 14.
There's your bid-ask spread.
So I was telling him about what we can do, yada yada, and I told him about our affiliation with Land Advisors. And this is the broker guy, not the actual guy. And he's like, well, he's not real happy with Land Advisors because they came with a $6 million BOV and he's got an appraisal of 14. And so I don't have anything to look at, so I couldn't say one thing or other than I said, well, I don't believe in appraisals all that much, and our guys are best in class, so I would tend to go with 6 million. But so then I started walking through. Okay, if it's unentitled today, and we all know Newhall Ranch has been trying to get their property entitled forever. So call it 3 years to entitlement. No one will buy paper lots, so you got to develop it. So now you're looking 5 years. So my guess is they discounted that thing way back, looking at 5 years, and that's how they got to their 6 million. And so anyhow, that's just an example of a guy who he's not absentee per se, but he's in Utah. He's sort of the managing member of his family on this deal.
Probably wants to sell. I mean,
Yeah.
I think ideally would love to have money in his pocket.
Wants to sell, but he's probably unrealistic about what he can get. So, but that's a great example of, okay, we could potentially hook him up with a joint venture partner to get his entitlement, and I assume that the property's a decent property up in Valencia. But I just need more information at the end of the day. And so one thing that we'll get asked by equity is, okay, who's on this guy's team? Can he execute the business plan? I mean, he's in Utah. He does this part-time, maybe not. But then we can look at, we have a couple organizations that will do sort of a co-development deal where they'll essentially take over, put in the money, and cut this guy in for something on the backside. So yeah, that's a good example of calls we get where we can work together, and either we end up finding the money or he gets realistic and you guys get the opportunity to sell the land for him. For 14 million, of course.
More, once you get the entitlements, right?
I try to explain to him, like Land Advisor says their whole incentive is to get retail, so they have no incentive to lowball the number when they're doing a BOV. Quite the opposite. So I'm guessing that the appraisal is crap, but I haven't seen it.
Yeah, and this is Michelle. Is his name Hunt Williams?
I don't know the guy's name. I'm dealing with this quasi broker, but anyhow, it's I'm sure if you did a BOV early last year up in Valencia for around 260 lots, that's probably the same deal.
Yeah, it's the same deal. It's actually in Castaic. It's a little bit further out, so it's not as good a location as Valencia, but we can get into details later.
Yeah, okay. Well, it's in play, so just so you know.
And that's a scenario, just to wrap it up, and it's hard to not know what the ultimate value would be upon entitlement, but I think just off the cuff, how I think of that is, well, you contribute your land at a $6 million basis, and the other guy will spend the next $3 million in the few years to get entitlements. Now you have a $6 million component and a $3 million component, and this is where the creativity is the sky. As far as, okay, once the first $6 million will, and your pref go to you, the next $3 million, my pref go to me. Whether it's pari passu, whether he has priority, there's a lot of different ways that could be. Let's say at the end of the day, it's worth $22 million. So now you have, $13 million that can be shuffled up above and beyond the 9 that's going in. So, the $3 million guy could double his money, make 6, and now there's $10 million more for the seller. So ultimately now he's at $16 million. So I think if, by proposing those types of solutions, maybe a way to kind of to throw a hope certificate to a guy, especially when we're arguably higher up when the market's a little bit toppy, rather than being greedy and losing all of his profits now, locking in some now and hoping that he can recover more later.
Yeah, I was going to say, what we're seeing kind of joint venture opportunities, a property owner entitled to the site, it's ready to go from that aspect, but builders aren't touching it because it's not improved. Builders don't want to improve the lots. So we're trying to figure out ways to put joint ventures together to actually do the land development.
Mm-hmm.
Either the builder doing it or a quasi land developer coming in and then delivering lots.
Mm-hmm.
So that's where we're kind of seeing joint venture opportunities, or trying to.
Makes a lot of sense because that A&D financing isn't there, right? For the guy, he doesn't want to. He just want to get out of paper lots, so he doesn't want to carry it through, and he can't find the capital, as we know well, for that land development component. So
we're working on a couple deals. Call yesterday with a land developer that we're trying to figure out a joint venture with someone to do the actual.
Do you have, and just saying, do you have, and maybe use the same topic, but do you have actual numbers that we could go through, or?
Not right.
Okay.
Yeah, not right now.
But we have a new source that is looking for opportunities like that, and they'll be called the co-GP. So they'll bring in the expertise, and they also will bring in the capital. Yeah, but they're going to want to kind of run the show per se. But and that's less of a JV structure and more of a partnership, co-general partnership. So for deals like that, so if it's a well-located site and pretty big, they would have an interest. And we're pretty tight with the principals, so working on a couple of deals for them right now. So we should talk when you have those types of opportunities.
Sure.
Well, and that's perfect for the uneducated seller who, 5 years ago an appraiser told me that this was worth this much, so I'm not going to sell it now, and someone else to come in and take control and kind of do it for them. It'll be good.
And the family situations is, you got mom wanting to do X and daughter wanting to do Y and son doing Z, and it's just kind of a mess. So it's good to have someone come in and kind of take control.
Ian?
The other thing that gets in the way of those types of deals is guys who want to protect their tax status. They don't want to move any dirt.
Right.
And so in those situations, does the landowner sell essentially to the JV for X number of dollars so that he protects his tax status? He gets an immediate transaction that he wants, but then ultimately at a lesser sales price than what he was really hoping for, to get it in at a lower land basis, to get the development work done, and ultimately have something that's worth selling to a builder.
Yeah, that's a really good question. As far as, going back to your point about the land development, I think I've been thinking about it more from a going vertical, but I can see where that gap exists and where there's a real opportunity for you guys to plug people together to take it to the next stage so that you do have finished lots then to sell on the back end. As for tax status, great question. I don't know the answer to that. My non-legal tax opinion would be that if you aren't changing title per se, then it wouldn't trigger an actual sale and tax consequence. That you're contributing the land into a entity that another investor would come into that entity. So I would think that you could preserve your tax and push it down the road several years until you ultimately did sell. But I can't say for certain.
But if that JV is developing the land, then that changes their tax status, correct?
Yeah, I don't know.
Okay.
Yeah, you become a dealer at some point. So for our next session, we're going to bring in a tax attorney.
That's why those guys land bank. That's the whole idea behind land banking was the tax that changes title to the equity guy, so the builder doesn't have it on his books for Wall Street.
Uh-huh.
So yeah, we'll when we have our Shepherd Mullen lunch,
We'll get their opinion.
we'll get their opinion. For free.
What about, and I'm thinking that, one thing that I think we need to be aware of, and this is just constant dialogue, and feel free to reach out to us anytime to talk about this. The risk that we run with this is getting too complicated for the seller, oftentimes uneducated. So I think where the canvas is wide open and we can be creative, I think the key is to come up with something relatively simple in nature that they can understand, and in turn, I thought that when you talk about multiple family members, there are often going to be several people that are also going to be lack sophistication that need to be informed as to how this is going to work. So I think the simpler we can keep it, the better. And then that may even also lean in more of a preferred equity structure, as far as I think people get the concept of my money comes out first. Okay, as long as my money comes out first, I feel good about that, and that's a really simple kind of concept that someone could explain on to other family members.
Yeah.
Anybody questions on terminology or things that you're seeing out in the market?
You must be on mute.
Yeah.
Well, deal we just did with IHP up in Oxnard, closed a couple weeks ago. That's IHP has a quasi JV preferred structure, so they actually get their capital back first, which although it's not strictly preferred, so it's kind of a hybrid.
Why don't you go over the deal?
Well, it's you probably saw the blast. It was 152 lots in Oxnard. It's next to the Dallas Cowboys training camp field. If you know anything about Oxnard. So it's been an egg. It's been an egg forever. So a company called Ravella Holdings, Phil Ram, who used to run a company called West Millennium pre-downturn, which worked out of their issues over a long amount of time. Anyhow, he went to work with Cerberus on the asset management side, and they had Alan Kazan had a portfolio that Cerberus had financed, and in the settlement they ended up with a number of assets. This is one of them. So we went out to market with the deal, looking for equity. The challenges were Oxnard's a secondary market was our main challenge. So anybody that from the equity side that was sort of, say, New York based or not familiar with Southern California, as soon as they looked up Oxnard on a map, they were like, well, this isn't LA. So it was kind of a short conversation. The good news was we ultimately got to IHP. IHP has done deals in Oxnard. Oxnard, as you probably all know, is very difficult to get entitlements. So they actually saw Oxnard as a plus. And in Oxnard, it is a secondary market, but one thing I like about it, 10 minutes away, you're at the beach, so it's not like you're in Palmdale. So it's got, and the schools are decent, and it's got a new retail, etc. So anyhow, it took a while to get done ultimately, but with IHP, again, their structure is a little different, where they're going to get their pref and capital back prior to the developer. So it has some aspects of being preferred equity, some aspects of being a joint venture partner, but they're a great partner. So what we had to do is convince our borrower, who's been doing this with friends and family. He had already raised allegedly $10 million of the $14 million needed. So we basically convinced them, hey, you're in a growth mode. Your friends and family are pretty much tapped out after this. IHP would be a great partner. They've been around forever. So ultimately, we convinced the developer to go with IHP. To me, it'd be crazy not to. And we got the deal done. So now we're getting teed up for another deal with them, which is Santa Clarita. They have another one of the assets that Cerberus owns and Ravella Holdings have been managing is in Santa Clarita. It's about 450 lots. So that's teed up for about a year from now. And that'll be a great site. So hopefully we've set ourselves up to get another transaction down the road, and IHP knows that property as well, and they're interested in it already. So that's kind of the gift that'll keep on giving, hopefully, if we do it right.
Do you recall what the split structure was?
God, not
Sorry,
off the
put
top
you on
of
the
my
spot.
head. It was a 12% preferred.
Okay, so they got their money back in a 12 first,
Yeah.
and then there'd be kind of a terminology there. Is someone asking a question out there? Going back to just basic terminology that's important to understand. Someone gets their 12 and their money back. If they're in a preferred position, the next person would have a catch up where they get their money and their 12 back. And that's when you go into the waterfall split. And I'm curious as to what that structure was, because generally speaking, as we mentioned earlier, because IHP was in a lower risk position of getting their money back in their 12, they should be taking a lot less of the profits. It wouldn't be your typical 70-30 split as we talked about under a pari passu structure. I'm guessing it's more of a, out of the gate 60-40, 50-50, and then at some point along the way, once you hit certain hurdles, perhaps Ravello got more than 50% of the profit because they had to give up the security to IHP of getting their money back first.
Yeah,
So
I don't remember the exact splits, but I think they're going to get low 40% of the absolute profits, which is pretty good. So I'll call it 41-42% of the total profits. The sponsor are going to get. So.
Do most capital players like IHP, do they go into each deal trying to, like, with their same set of, these are our terms, we want this much of a split, we're going to do this structure?
More or less. I mean, there's certainly flexibility in negotiation, but they, certain people they have a JV fund, and they only do JV, and it's all pari passu, and you may move your pref a little bit based on the risk of the deal. You may move your splits a little bit based on what the co-investment is, and it really comes down to the strength of the deal and the sponsor. They'll move their deal some, but generally speaking, they're going to come out with a typical structure that works for them.
Yeah.
And just like a preferred equity guy, he's going to live in that world and have a general structure that you would have. Now, I will say, so for the most part, yes. However, I think right now what we're seeing a lot of is those barriers between I'm just a JV equity guy, I'm just a preferred equity guy are kind of being knocked down, where people are having a lot more creativity on how they want to approach deals. I think partly because the JV equity guys realizing that we're maybe a little bit at the top would rather be in a preferred equity position. I mean, I think it's crazy for guys. I would love to be in a preferred equity position, because when you stress the deal and you do a really negative scenario and a really positive scenario, really positive, maybe you get a 25-30 IRR. Really negative, you get 0, right? So you have a really wide volatility of what your returns could be. In a preferred equity structure, your downside mainly being 8 or a 10, your upside's a 20. So you're in this bracket of always getting an 8 or a 20. And in my opinion, I would forego the extra 5-10% of upside for the safety to know that I'm going to get my money back in some kind of return. And I think that's how a lot of JV equity guys are looking at the world right now.
Yeah.
So they're shifting into more of a conservative kind of a mode in that preferred equity. So I think you're seeing a lot more flexibility and creativity as to how guys are pricing deals. And ideally, if you really believe in a deal, you may want to take that joint venture risk to get a little bit higher upside.
Yeah.
But if you're a little bit suspect about the deal, but you still want to do it and get some money out, then maybe you shift to more preferred equity structure where you just know I'm going to be protected.
Yeah.
And I think that's how a lot of the capital guys are kind of looking at the world right now.
Another thing capital's going to ask for equity side is can you get bank debt? And a lot of them can't get bank debt because development loans are hard to come by. So you got to have a decent balance sheet or a banking relationship. So we have that hurdle all the time. So in the case of Ravello Holdings, he has okay credit support. He had a BK 7 years ago related to one particular project. So we had to explain that of how he worked through it, all his problems, other than this one where the bank involved sold it to a vulture fund, and vulture fund was just out for blood. So he ended up personal BK, which isn't the end of the world because it was such bad times. A lot of people had credit issues, but so he actually brought in a friend of his to sign on the guarantee as additional credit support, and we've seen that on other deals as well. So, again, an important part of that particular deal was they had Preferred Bank, a term sheet from Preferred Bank to do the deal, which really helped IHP get comfortable. Because if you can bring in the equity, but you can't find bank debt, cheap bank debt, you gotta go out to hard money. Or if you can find it at all, that hard money is gonna be priced probably in the 10% and 2-point range at best, where the banks are lending at, call it 5% and 1 point. So it's at least double the price.
And a good, and well, most equity guys, but certainly the ilk of IHP, they're not gonna wanna sit behind that hard money loan. It's just too expensive of debt.
Yeah.
So it's almost a dead deal unless that sponsor can come and bring solid bank debt to the table.
Yeah, so we have a deal up in Camas, Washington, which is a suburb of Portland, just across from the Portland airport. And in that case, we brought in Castle Lake as the equity. Steve Sims was the main person handling that. And they did without leverage. So now we're trying to backfill it with leverage. The good news is Castle Lake will put up some of their funds for credit support, not on a repayment guarantee, but on a completion guarantee. So we were able to get a really good term sheet a week or so ago, which I think they're going to go with, from a new bank in town called Flagstar. They're actually out of the Midwest, but they're one of the few banks that's active in home building. And so we'll get a development loan. But as most banks, Flagstar wants a vertical opportunity as well. So we're trying to marry them up with some of the builders who are going to buy lots in there, David Weekley being one of them. So they can go to the credit committee and say, yeah, it is land development, but we are also involved in the vertical side, which is really their primary repayment source, is selling homes at the end of the day. So that's important as well, is there a vertical component? A lot of the banks will look for that.
Well, guys, I think, again, if there's not questions or other deal examples, I don't think we want to exhaust the time and the call here. But I think this is an ongoing conversation and something that we're going to see more and more of, I believe. And not only do I think that it's going to be kind of requested more by sellers, but as we talked about before, the more that you are aware of it and can speak confidently about it, then the more that you can go in and offer that as a potential opportunity for the seller. If you're really just hitting your head against the wall and the guy's not wanting to sell. So, I encourage you guys to reach out to us individually anytime and just give us numbers and say, hey, here's the scenario. Here's what we think it could be worth on the back end. Here's what we're trying to sell it for. Here's where he thinks he wants to sell it for. And we can play with some different scenarios to present to you guys so that you guys, and I think even if you want to bring us on a call, we're happy to do that as well. But at least armor you guys to go in with more than one solution as to how the deal could get done.
Yeah, I think it'd be good just to hear from us, because we're in the market every day on the capital side, to tell your client, here's what's happening today. And some people, like the guy up in near Magic Mountain, that's where I remembered things. He just needs to understand what real reality is, and he may tell us that we're full of crap, but that's kind of rule number one in real estate: don't fall in love with your real estate, and that's probably his issue at the moment. But he may, again, there may be some family event that they want to sell. It's time to get out, and so maybe he'll have it. A year after we did the B of A, maybe he's seeing that he needs to exit, and he'll be a little more realistic. Who knows?
And don't let those guys confuse you either. I think that's why it's good to be more educated on this component, because I think we've all been in situations where someone's told you something. And you're right, but you're kind of like, well, wait a minute. Now, that guy maybe I'm wrong and he's right. And I think the more educated, and it happens with us too. As I mentioned earlier, we hear these guys with crazy deals. The other day, someone mentioned they had a 75-25, 75 to them, 25 to their investors. And it shook we're scratching our head like, really? Could that be possibly right? But sure enough, he was wrong. And so I think the more educated you are at this, the more you could kind of stand up to your guys and know that what you're saying is right and what that guy is saying is incorrect, and in a very politically correct way, tell him that. So I think it's just all about education and terminology, so you guys are confident going into these conversations.
Cool.
Thank you, very informative.
Yeah.
Good.
Thank you. I think that a waterfall lesson would be very good. I know we've touched on them, talked about having ones just on that, but that seems like it'd be very beneficial.
Well, maybe when we hang up, I'll draw it for you on the board if you want.
Diagram just for me.
Anyway, hey, if there's no further questions, let's continue the dialogue, and you guys please reach out to us anytime with any specific deals that we can help you with.